And we're live. G'day, this is Xenium.Live on a Friday afternoon where we're talking to you about all things money, finance and property. I'm your host, Scotty North, and thank you for joining us today if you're joining us live on the re-record or on our podcast, which is called Xenium.Live, coincidentally, available at all podcast apps, stores and all those sorts of places. If you're watching on repeat, email us your questions because we won't be live, obviously, because we're on repeat. But if you're watching live, feel free to jump in the comments box, type in a question or a comment, and we'll be able to discuss what you're asking or saying live on the screen as we go forward. Well, today being Friday in Australia and lunchtime, we all know that that's the end of the work week. And before the end of the work week happened for this fella, I thought I'd grab him as he's in lockdown and he had to move from the study to the room next door onto the couch for the rest of the weekend. So I'd like to welcome Nathan Keating. G'day, Nathan. How you going?
G'day, Scotty. How are you, mate?
I'm good. So you are in Melbourne at the moment in legitimate lockdown, unlike
total lockdown.
Other places. Yep, total lockdown.
And I'm actually by myself, so I'm stuck in isolation. It's driving me crazy.
Well, mate, I've known you for a little while now, and I'd like to say that that's scary to me because I'd consider you fairly crazy before lockdown, and to consider that makes you worse during, that's a potential threat, I think, to society.
I think it's okay while I'm contained. It's when I get let back out again, all hell could break loose. But we'll see what happens.
All right. Well, today we didn't get you on to talk about lockdown, right? I wanted to bring you on, have a chat because you were, had to fit you in your majorly busy schedule down there in lockdown. And we were discussing a few things the other day and it came to our attention and said, that'd be a good topic for a show, which is something about, borrowers and what have you. But before we get to that, tell me a bit about yourself, because I believe that a little birdie told me that you were an accountant specialising in a certain area. Then you went to be a banker, and then you went to be a broker, and you've won certain awards and that sort of thing, which is, I don't know if that's just you saying that or if that's legit. So how about you fill us in on that?
I did give you the brief earlier on there, Scotty. I was kind of hoping you'd be able to do the boasting for me, but I started life as an insolvency accountant and got sick of everyone thinking I was a bit of an asshole. So I immediately moved over to banking, and from then on, I've never looked back. A total change there. I've been in and around banking now for well over 20 years, and worked in banks. I've worked supporting banks, and for the last 12 or 13 years, I've been a finance broker and consultant, helping people to deal with the banks. So there seems to be a bit of a common theme in most of what I've been doing for a while.
Mate, look, I've got to jump in there because you're kind of breaking the mold for me. I mean, when someone says you're an accountant and a banker, I mean, I have a certain thought pattern around what that might be in terms of their personality, but you seem to actually have a personality on when we have had our dealings. Mate, how did you manage to wedge that in?
Well, I don't know. I grew up on the rugby field, and I like to blame rugby for most of my bad habits. But I don't know. Maybe it's just my father was a banker, and he sort of was out of the mold a bit too. So I had a good mentor in that regard. And he actually started our broking business. So
okay, so he started the broking business. So that was what, in 2008, was it?
Yeah, about then, 2008. It was about April. I joined in February, and I think about April the GFC landed and the banks all shut their doors. And my decision to go into broking sort of seemed not such a good one from that moment onwards. So we spent a couple of years trying to, we ultimately had to move to stop trying to introduce new clients to banks and actually help businesses get on better with the bank they were with. Because banks just weren't interested in new clients for a while there. It's a bit like that now at the moment. So, that sort of forced us to be a bit more creative, and it became more of a consulting business for a while. And we've been helping businesses and individuals sort of battle the banks ever since. So that's what sort of gives me my jollies. I think I find that more, a lot more stimulating, because banks are a special breed. They're actually always right, believe it or not. They know more about people than the people know about them, but they are also extremely predictable. So as long as you know how they behave, it's easy enough to sort of work your way around them.
Well, that's a good point. So, you came in and you went from the security of a bank employee, type arrangement to your own business coming into GFC. Obviously, as you said, you've learned a lot at that time, but you're seeing similarities in the market now in both how the borrowers are acting and how the banks and lenders are acting.
Yeah, it's a different crisis now. The crisis at the GFC was a liquidity one for the banks, and they didn't have any money to lend. The crisis today is more a concern. They've got plenty of money, but they've got concern around the borrowers having enough money. And people these days in banks, their careers, they're sort of very worried about their careers, and there's a lot more incentive to retain your job and not lending than there is to retain your job by lending. So we're sort of all seeing and experiencing the banks sort of clam up a bit, and quite rightly. It's very hard at the moment in this environment to predict, whether a business is doing well or a person is doing well or not. And the banks are obviously opting to hold on to their cash where possible, unless there's a sort of a really blatantly obvious opportunity to lend to somebody who's clearly in good shape. So we're seeing a lot of that at the moment.
Yeah, look, that's interesting. You talk about being in good shape, because when we did some discovery on you, on your background and other bits and pieces, my research team came up with, there's obviously a time when you transitioned from banking to broking, and you had to do some stuff on the side to make some cash.
Well,
is that right?
Times were tougher there initially in the business. We weren't doing a lot of broking, so I had to put the body on the line and the footy socks, and just really see if I could get out there and make some dough. And so I was trying everything. I had medium success with that, but I've sort of erred back into broking as the years have gone on.
So you're even better broker than model, mate. So you're pretty impressive then, if that's the case.
Yes, thank you.
So all right. So you've come together with a couple other guys on a small project at the moment. So your business that you started was called Pearl Financial. Is that what it was then?
Correct. Yep. Pearl Financial Services, and we've drifted into Pearl Business and Mortgage Finance over time. And Yep. And now we're working with a friend of ours in Brizzy, and we're going to merge our businesses and see what we can do to sort of take on the world.
Well, that sounds pretty exciting. And is there any advantage in that compared to what you were currently doing? Is there a new target, or what are you looking at doing there?
We're sort of building ourselves to a much broader appeal. We've been sort of focused very much just in Victoria, and we think we're pretty good at what we do. And we found our friend in Queensland was very like-minded, and there's an opportunity for us to be helping a lot more people than just other people around us in Victoria. So we're looking to really sort of broaden our appeal. So that's the focus. I'm being a little bit elusive. We're due to launch in the next week or two, but we're not quite there yet. So.
Oh man, here I was thinking I was getting the inside goss, because we do broadcast globally, so the whole world is listening. So I can understand your caution there. That's fair enough. All right, so with
give me a week or two, and I'll come back on and
right.
tell you all about it.
Okay. Well, only if we can dig up some more photos of you, mate. That's all.
Well, I'll see what I can do.
Okay, so we were having a chat earlier in the weekend, and just talking about all things money and stuff, as we always do. But you mentioned to me about an issue that you found that was not across 100% of borrowers, but a lot of borrowers a lot of the time had this issue. which was, I'll let you talk about it, but I thought, well, you know what, we should be talking about that on the show. And because what happens that I find in any of these situations is that we all think we're on our own, right? Oh, no one else has a situation like me, or no one else has a credit card bill like that they pay off at the end of the month, or that they don't pay off at the end of the month, or no one else has that. So everyone else owns their cars. Well, am I the only one who's got a car loan? It's like all this stuff, whereas in reality, that's not the case, right? I mean, there's a lot of people in similar situations, but we feel very alone. And when it can be kind of daunting talking to someone like a broker and go, oh, well, yeah, you know, I spend this much on school fees, I spend this much on food, and you go, yeah, that's normal. And all of a sudden people go, oh, what do you mean? I thought that, you know. So one of these things is a problem that I've seen. So I'll let you talk a bit more about that, and we're going to have a discussion about it.
Well, Scotty, my father always said that banking is the second oldest profession, and ultimately nothing has changed since the very beginning. So there's nothing new in banking and finance. So you'll find that if you've got a problem, you can bet that problem has been going on since the turn of time. There's a bit of technology that changes and what have you, but ultimately the rules in lending are always the same, always have been, and probably always will be. Some of these fintechs are trying to reinvent the game a bit at the moment, and it'll be really interesting to see how they go. But I think ultimately they're just sort of finding more efficient ways to do what we've always done. I guess the observation that we sort of had earlier in the week was about challenges that people face today with personal lending in particular, and the difficulty. The reality is in the modern banking environment, as a broker and the banks as well, are having to really interrogate customers to make sure that they're comfortable, that the borrower is going to be able to afford what they're taking on. The Royal Commission pushed a lot about responsible lending, and that's become quite a yoke around everyone's neck in a way, but it's all for the right reasons. What we've found is that there's a lot of businesses, a lot of people out there that are sort of leaking cash, and when we sort of go and interrogate their financials and their personal financials, there's a lot of sort of borrowing capacity that's lost through poor spending habits and poor personal structuring, and there's a real opportunity to sort of increase their borrowing capacity simply by sort of tidying up their personal affairs, and that's something that you can be done sort of 3 to 6 months in advance. If you can do that 3 to 6 months in advance of you wanting to get your finance, you'll find that when you actually turn up on the day to actually present yourself for a loan, you're going to have a much better chance of firstly getting the loan, and secondly getting an amount that you might aspire to.
All right. Well, I'm gonna dig into that in a sec. We've got some. We've got Michael, who often jumps on our show to comment. Michael's watching today.
Hi, Michael.
G'day, Michael. How you doing? And Michael's got a question for you. Did borrowing capacity drop in 2006 for borrowers? So I'm assuming he means that leading up to GFC, did borrowing capacities drop?
Well, I wasn't broking before then, I was more in the banks, and I think no, I think borrowing capacity was actually much higher. It was much easier pre-2007 to get a loan, and I think in general, even if the reality of someone's borrowing capacity was low, the diligence that the banks used to determine that borrowing capacity was so much less than it is today.
It was low.
That you could have got a loan, as long as it wasn't quite as easy as fogging your mirror, but it wasn't far beyond that relative to today. And same with both business and personal. It was there was a lot less. I think there was a lot less information available in 2006 for banks to use. So there was a lot more, and historically, bankers have used a lot more gut feel than they do today. That's probably the thing that has changed over time. Is that more and more now banks rely on specific information that's available to them, and less around the personal relationship and meeting the person and working out whether they're a trustworthy soul that you would actually introduce to your family, let alone lend money to.
Well, I mean, in 2006, my kids had called that the olden days. So, I think you're right. It was about that meeting relationship, filling out documents and all that sort of stuff, whereas really now we've transitioned into completely data-driven results and interactions, right, in pretty much just about everything we do.
And a lot of these fintechs that have come out now are offering some really great, very quick, very reasonably priced solutions where you never actually meet the people. It's all about the data and whether the data infers that you're going to be a good person or not. Time will tell whether that's going to work. I think banks still struggle with that from a business lending perspective much more, but for personal lending, I think the statisticians are winning the day there, and it doesn't matter, how creepy you might look and how many tattoos and piercings you might have and other sort of insidious things that historical bankers would have recoiled at. As long as your data looks okay, you're all good to go. So, which is good if you're into tattoos and piercings. It means the world's really opening up for you.
Or underwear modelling. So you made a mention before of getting your personal affairs in order, and I wanted to come back and touch on that. Now, let's clarify that. We're not talking about getting your wills and estates in order, although that is a good thing. When you're talking about your personal affairs when it comes to lending, you're talking about some people have got, it used to be AGC, right? Now I'm showing my age, short-term debt and loans and all bits and pieces all over the place, credit card, car loans, whatever. And you're saying that it's much easier to manage by rolling that into, one loan, one platform, one arrangement?
So your borrowing capacity is a very easy calculation. It's ultimately how much income do you have, how much money do you spend, and what's left over, and does what's left over cover the amount of the new loan with a little bit left over, a little bit to spare. So the more you can reduce your expenses, the better. So you need to really, months before you're getting serious, you need to go through your expenses, because we're going to, as a finance professional, and you need to go through your expenses and you need to have a look at it. And if there's opportunities to make savings and reduce unnecessary expenses, then you need to take them. So an example of something you might do there is you might have a look at all the extraneous personal credit that you have. And these days people can get personal credit from lots of different ways. You've got credit cards, the old-fashioned credit cards. You've got afterpays and zip pays if you're into buying things using some of these new tools that are available. There's car loans, and then there's companies like Nimble and short-term payday lending that also helps people get through from day to day. The less of those that you've got, the better. You should look at perhaps sort of consolidating some of that. If you've got an existing property loan, you can consolidate into that, but otherwise consolidating perhaps into a nice cheap personal loan is something worth considering. So there's some very reasonable personal loans out there. Some of the tech companies I've seen, you're in the 6, 7, 8% mark rate, which sounds high compared to a 2%, 2.5% mortgage, but for an essentially unsecured loan, that's a very reasonable alternative to paying 15 or 20% on your credit cards and beyond for some of these other payday lenders. That's one quick way to save some dough.
It's a huge difference, isn't it? I mean, it's, we're talking, 5, 6, 7s for a personal loan versus 15 to 20 plus. Well, I don't know what credit card is. Maybe they're down to 18s now for your credit card. I mean, that makes a big difference. And the other thing too is that with the amalgamation of the debts over a specific time frame, it's not just the interest rate efficiency, it's all the little bits of paying this principal down on this one and this principal on this one and interest and whereas it all comes into one. It always seems to save people time and money. Is that right?
It's time and it's money, and you're freeing up cash flow, and ultimately, if you're aspiring to get your first home, you need as much cash flow as you can to be able to demonstrate to people and yourself that you can afford the mortgage that you're going to need to buy the property that you want. So the more you can tidy these things up. The other thing that you've got to look at too is that you've got to be conscious of the fact that we're going to be judging you as we go through your expenses. So if you're an avid gambler, you know, don't be putting that on your credit cards. Don't be putting that on your debit cards. If you enjoy a tipple or two, you know, limit the number of times that your credit card shows up at Dan Murphy's. These are all things that you'd be surprised how much they influence a lender as they're sort of going through and having a look at you. You do get judged. You know, ultimately lending is done by humans more often than not, and they're going to be having a look at you. And if they see a prolific gambler or a prolific drinker or other, you know, a prostitute attendee, these are all things that will count against you morally as well as financially, I suspect.
Mate, I think that's a big call for you to go out and call banks humans, but, you know, I'll let that one pass. So I actually got a note here to ask you about, you know, there's the running joke between sort of the 20-something-year-olds, you know, when they go out for dinner and they share, you know, so one person pays for the bill and they all pay each other, and they're doing the whole, you know, send your mate $100 and put, you know, weed on the transfer, yes, or speed, or you know, whatever. Yeah. So you're really saying don't do that?
Yeah, I don't know that it's going to work in your favour when your broker and or the bankers are going through your bank statements with a fine tooth comb. They are human though. Hopefully they'll see that as funny. I would.
Yeah. That's fair enough. We got Michael asking, how do major banks view granny flats in the sense of valuation on the property? Do they value the house comparable, then add granny flat costs, or is it based on the yield it's returning? So that's an interesting question.
Yeah, it is an interesting one. And to be honest, I don't have an obvious answer. What I would say is that ultimately banks lend against a valuer, so it's going to depend a lot on what the valuer says about the granny flat and its influence on the ultimate value of the house. So banks will and its ability to resell. So if it's an ugly looking granny flat, that might have some negatives, but ultimately it's mortgage lending does come down to quite simply valuation, you know, loan amount next to the valuation, and they'll lend 80% of the value, whatever the valuer says it's worth, or up to 95% if need be. So hopefully that answers Michael's question.
Yeah, no, well, if not, I'm sure we'll hear from him again. Look, back on the personal loans, is it, if someone has 5 or 6 different things, you know, a couple of credit cards, maybe a car, maybe not, but, you know, the short term, you know, you go on to Joyce Main and bought something on finance, whatever. How easy is it to roll it in, and how quick does all that happen?
Well, I think some of these new lenders out there can do it within a matter of hours. I mean, ultimately, so you can be applying online, and they'll run their algorithms, and you either fit or you don't. And often the pricing is driven by your credit rating. So as long as your credit rating is good, the pricing will be sub 10%, and you're in for you can get a loan, you know, within almost 24 hours of making your application. I guess that raises another topic too, which is how do you manage your credit rating? Because ultimately, that in this modern lending environment, personal lending, that's driving a lot around the rates that you're getting, and credit rating is a function of these days, it's a function of loan performance. So any existing facilities that you got, the credit bureaus are watching to make sure that you're paying on time. and you're being judged on that. They're judging you on the quantum of the debt that you've got. If you've got lots and lots of different credit providers all providing you bits and pieces, it's probably inferring that you're living beyond your means, and that in turn is going to reflect badly on your credit score. And then the amount of inquiries that you're making. So each time you go and ask a lender and they say no, that's a black mark against you in a credit score sense. So all of these things are sort of working against you.
So if you've got lots of those different debts around, and it's pretty easy to get a personal loan, it's not only better because it improves cash flow and your ability to of your case for your master lender, like your main lender for your home, but it's also going to clean up your credit rating over time. I mean, if you don't have all these debts and you've got one personal loan and then you can sort of manage that for 3 to 6 months and then you go and get your home loan, that's going to look a lot better than going in with 5, 10 other little loans.
I agree.
Right?
I agree. I don't know how quickly it will show up. That's a dark art that I'm not exposed to, but naturally the conclusion will be that you're actually on top of your game. If you've got one loan, you're paying it down, you're paying it on time, you're not continually going looking for more lending, and the longer you can live your life like that, the higher your credit score is sure to climb, I would imagine. So yeah, good times. The other thing that personal lending will allow you to do, I learned today actually, is you can actually pay your deposit with a personal loan. So if you've got 5% genuine savings, so you've saved enough for 5% of the value of the house, you can get a personal loan. I learned today for up to 4 times the value of the amount of cash that you've got, which brings you into sort of sub 80% LVR lending territory. And as long as you can afford it, and people are lending to you responsibly and you're living within your means, that's a really good way to get yourself through without having to pay mortgage insurance. It's actually called a no mortgage insurance loan, I think it was. So yeah, there's a lot of good things to be said about personal loans out there at the moment.
Mate, I think that's really good info, and thanks for that. And if you want to know any more about personal loans, you can hit us up on our email, which I'll give you at the end of the podcast. And of course, you've had all that information, our phone number scrolling the whole show there, and I'll give that to you shortly too. But Nathan, I had 2 more questions for you. In our discovery of your background, it came into our knowledge that you're involved in writing a book or a chapter or a page of a book, or maybe it was you own a book. What was that about?
A business partner, an old dear business partner of mine, who tours the world, well, not at the moment, but usually tours the world speaking on cash flow, was invited to contribute to a book by a gentleman called Vern Harnish, and he wrote a book called Scaling Up. And my partner and I sat down and pulled together the chapter on cash flow in that book, and that was a real honor. It was wasn't easy to do. It's a lot of work just for a chapter. I'd hate to think what it'd be like to do the whole book, but that was pretty cool. I've sort of dined out on that for years now. It's been terrific.
All right, that's good. And where can we get a copy of this book?
I think it's all decent bookshops and online bookstores. Scaling Up.
What was it called again? Scaling Up.
Scaling Up. Yeah, by Vern Harnish. It's and as proof, I am actually mentioned in the foreword of that chapter as one of the contributors. So
there you go.
It's real. Yeah.
Well, we're about to close up. It comes to my last question, being just hanging the whole show to ask you, and that is, how are you related to Paul Keating?
I'm not. I wouldn't own up to it even if I was. Although he's quite funny, and I do miss the notoriety of having a prime minister that shares my last name. That was fun at the time.
And did you use that? Did you like get into hotel queues quicker or something? Like, how did that work out for you?
Well, I was young. I was only young, so no. My dad's name's Peter, so he was P. Keating, and that came in handy for some bookings on occasions. People were very disappointed when they saw him walk in the door, or not, depending on their persuasion.
And yet they would have all had their eyes light up when they saw you walk in after in your
my jobs.
Yeah, that's right. Oh, look, Nathan, it's been a pleasure.
Thank you, mate. I've enjoyed being here.
Yeah, thanks for joining us today. And look, I think it's important that we can recap there that the most important thing that borrowers need to know right now is that you're not alone. A lot of us are in the same sort of situation, and that you really should consider talking to a broker or advisor about your financial situation well before you need to go and look at lending and borrowing for a house and other bits and pieces, because there's lots of clean up things that you can do. And personal loans to clean up all those secondary debts that are all over the place is something that is quite helpful. And as Nathan said today, not only cleans up from a cash flow perspective, but also potentially from a credit rating perspective. And that's very important. Nathan, thanks again for joining us on the show. I really appreciate you coming on.
Pleasure. And thanks for the invite.
Mate, that's all good. All right, this has been Xenium Live on a Friday afternoon. That's it. In Australia, the whole country shuts down now. We're off the books and we're gone till at least lunchtime Monday, right? That's just how this place works. If you've missed any of our episodes, feel free to join us online and catch them up on YouTube and our YouTube channel at Xenium. And also email us at hello@xenium.property. So that's XENIUM.property, no .coms, no .aus, just hello@xenium.property, and you can give us any feedback on that, or on any of the videos we've got, you can make a comment. Thanks again for joining us. Until next time, I'm Scotty North, signing out.